faudrait que quelqu'un fasse sur 12h30 et que tu reviennes pour suite 13h15.
À midi, oui. Ah, putain.
Hello, everybody. Okay, so we're good to start on this session. What is your token worth? So thank you very much for being here. There's so many awesome things going on at this conference. I really value the fact that you've chosen to be in this room today to hear this live. I'm not affiliated with any well-known companies or institutions, so I think a little bit of an introduction is in order. I got into blockchain quite late compared to a lot of the people speaking on the stage, starting late in 2020. And before that, I was working as a financial analyst, specializing in financial modeling. I worked with startups. I built up my experience mostly helping to finance renewable energy infrastructure out in Latin America. And all of that was built on some strong academic foundations in finance and economics. That first blockchain gig, funnily enough, was to build a model to support a new token sale and listing. And, you know, I think I'm pretty good at what I do, but I can't take all the credit here, okay? A lot of us remember what markets were like during this period. My clients happened to do very well, and luckily for me, they were well connected. So I very quickly, in the heat of this market, became a go-to person for more of this work, and then that gradually evolved into more complex tokenomics briefs. Now, during this time, I had the privilege of working on developing a variety of product narratives and concepts. I took part in live pitches, calls with VCs, private investors, market makers. We had to navigate all kinds of market events and Elon Musk tweets. I saw people break promises, break agreements, blow holes through budgets, mismanage their token treasuries, get hacked, bounce back. And of course, I got to see how it all landed when we got to the bear market. Now, around this time last year, I decided, okay, I'm going to take some time out and I'm going to reflect and digest on what the hell just happened there and really make an effort to integrate those lessons in a way that coheres with my existing knowledge and training in finance and economics, because these disciplines should be able to speak to each other, right? So I think that's really important. One of the outcomes of this effort was I developed a teaching course on the tokenomics for token sales and listings. You've got a coupon there if you're interested. And I also started a YouTube channel called Token Design, aiming to, explore tokenomics from more of this finance and economics perspective. And I began to engage with online communities like Token Engineering Academy, which is how I happen to be on stage here today. I'm deeply appreciative. So that's a quick look at my origin story, and hopefully gives you some professional context to understand where I'm speaking from with the ideas I want to share with you today. So what is your token worth? We're going to use this motivation to explore a lot of misconceptions and misunderstandings that unfortunately are quite serious and can finish you before your time. But, you know, all this is finance, and I'm here on the the token engineering stage. So how does that fit in? Well, let's look at definitions first. This has already been published today. Token engineering focuses on the design, validation, and optimization of token-based economic systems. Kudos to Token Engineering Academy for coming up with such a concise definition there. And if we look at the way we typically design our systems, we're very often focused on creating systems that generate and deliver utility to end users. And of course, this is massively important. The first stop diagnosis for any failed project is, oh, it didn't offer any utility. It was just a means for financial speculation. And it's ironic that the smart contracts, the very smart contracts that enable the potential for utility design, also can create a web of obfuscation and confusion that leaves us quite confused about how we really engineer something that has true utility. So this emphasis is absolutely important and valid. However, if we look at the way we use our tokens, they're not just narrowly used to drive or manage a utility-oriented economy. They're also used as financial assets to raise startup capital and to provide ongoing funding during operations, okay? Now, these are three very different tasks. And even if we look at the two auxiliary financial functions there, they are also incredibly different to each other. A lot of you in this room have the engineering training to appreciate that. If you are designing a system to do three very different things well, that is going to face you with a very different set of constraints and trade-offs than if you were designing the system to do just one of these things well, okay? Well, maybe some of you will reply, okay, well, what really matters here is that we get the utility right. So if we get the utility right, then everything else follows. We have real demand that is a basis for financial value to be sustainably derivable. Okay, I'm open to that. I agree with you to some extent. If you are going to market with an amazing product, something like Uniswap, but with real token utility, not just governance, then you won't need to be a genius about the way you engineer your token supply or even the way you manage your treasury to tap your tokens for their financial value. But unicorns are called unicorns for a reason. They are rare, and you should not make unicorn or bust your guiding motto here. That is not a strategy that will maximize your chances of success or even your chances of survival. So, most conventional startups take 2 to 3 years to become cash flow positive. Let's back that out into a more general economic statement. It means that for 2 or 3 years, you are going to be losing more value than you generate at a fundamental level, okay? Oh, but, crypto is different. It's exceptional. Now, please don't lean into this in some kind of lazy way. I really doubt that if this is the common experience for a startup, that there's not something deeply important that crypto isn't an exception to. But let's look at the way that crypto/blockchain, I'm not making a difference here. Let's look at the way that it is different. One way it really is different, and the source of a lot of confusion here, is that you get early access to public markets much earlier than if you are pursuing the equity route and you have to wait until you get to your IPO. Okay, if you're planning your business to rely on public market funding, you're asking them to back you for up to 2 to 3 years before you actually start becoming net value flow positive at a fundamental level. Okay, and maybe you get off to a good start, and then this guy shows up. Okay, that's it's going to be really hard to keep people's attention. We'll talk more about that. So if you're not an instant unicorn, but you have a project idea that with time and care and effort could become absolutely massive and self-sustaining, you'd better make sure that you have your finances in order first, because they are going to float the boat that you sail in. Okay, so introductory motivation here. Finance matters, and it deserves as much attention as the core utility features of your project. And even though, these problems, these financial issues may not be as mysterious as token utility, they are rich and complex problems to solve in their own right. And once you take this holistic approach and perspective, you'll find that these problems are interconnected. Your options to finance yourself once you're live and once you get going will depend on the structure of your utility economy, how it's running, and the decisions you took during your token fundraise. Okay? What is your token worth? Okay, we're actually going to answer this now. Are you ready? It's a classic one. It depends. Okay? It depends in particular on when you ask. This is one of the most important dimensions to consider. We have 3 time periods, in my view. Before you list, during your private sales, in early trading, and in later trading. Okay? Now, spoiler alert, I'm going to argue that the period in which you have most visibility and control over what your tokens are worth is in the private sales. Okay? So you can raise money through public markets, but it involves so many risks that unfortunately so many founders don't understand. It's very dangerous, and we're going to look into some of the details now. Let's start with early trading. So For some of you might be thinking, how do we make money in early trading? All of our tokens for team and company are locked up. That's the way we create reassurance for the private investors and for the public not to, that we're not going to dump on them straight out the gate. Very good idea. But here's the thing. Market making gives you a back door. Now, a lot of market making, the typical market making contract includes a profit share that's paid back to the company that's issuing the tokens, right? That's hired the market makers. The market makers know that this is a golden opportunity, and they will sell you hard on this. They will say, we can make you as much money as you manage to raise privately. And if you're on a smaller fundraise, they won't be lying to you. Sounds great, right? What's the problem here? Well, there are two issues. First of all, things may not go according to plan. The market may reject your valuation. You may not have stirred up your community enough. Some FUD might set in. And then you're stuck in a situation where you were planning to raise more money than after your private sales, and then you don't have it. And you're kind of stuck. You can't go to your investors saying, hey, well, I needed more than I said I needed. They want to see results from what you've already been given. So that might stop you. And then the other issue is that the way you maximize value extraction in this phase is by doing things that are borderline or outright market manipulation. I don't want to tar all market makers with the same brush or all market making. Let's be clear. It's an absolutely standard activity in traditional finance. When you are a company listing your equity on public markets for the first time in an IPO, you hire market makers. What's the difference? Those markets, transparent, incredibly well-regulated, monitored, and the structure of those markets really eliminates the opportunity for some of the manipulation that blockchain enables. Okay? Some warning signs you might want to look out for here if you're being encouraged by your listing partners to go for a really tight initial supply, really low valuations. Those might be signals, compared to your peers at sort of like comparable levels of public interest. That might be a cue that they're setting you up for maximal extraction. But frankly, you might also just be able to tell when you're being pitched to by some of these market makers. They are quite proud of all the clever things that they can do for you. Let's be realistic. Everybody is doing this. Regulation is going to close the opportunity, but it's not there yet. So it's going to be down to you to decide how you handle this. However you feel about all that, though, my main point is that offloading your fundraising needs to early trading comes with risks. Okay, what about later trading? At this point, the tokens have unlocked to you. It's all above board. Everybody came on knowing what the vesting schedules were. So that should be fine, right? This is often a point of intense interest from founders. They'll come to me and say, what's the value of all the tokens that we have at the end of year one? And if I give them a straightforward answer, this is the kind of look that gets into their eyes. Please, this is absolutely not the right way to think about the value of your token, okay? If you try to spend the millions that you think you have, you're going to end up in this really surreal world where the more you sell, the less what you're selling is worth. And you're in the situation which none of us have been, 99% of us are never educated to handle, because financial management is all about saving, and once you've saved up something, it's yours to spend. Not here. We've never had to deal with thin liquidity, okay? Thin liquidity limits the accessible financial value you have. You try and sell those tokens into the market, you run through the real buyers pretty soon. We're not talking about the imaginary ones that are being wash traded in by your market makers. There's a limit to the real buyers out there. And if you continue to try and sell and sell at the price, you will push the price down, and that will create a value narrative that is at risk of becoming self-reinforcing, right? So to make things worse, actually let's pause there. This is not theory at this point. Like, I worked with a project that was had tokens unlocking to them, and they were only able to sell 10% of the tokens that were unlocking to them each month without crashing their price. So month on month, 90% of their valuable assets were just piling up. You could just open cupboards and all these tokens would fall out. They're entirely useless. And, they hadn't factored that into their planning. So, it's a real thing. This isn't theory. The other issue you have is that this thin liquidity, unfortunately, in the early stages of your market, is likely to get even thinner. Yes, your community is out there, and they're all excited about that initial launch. We were hearing earlier about the importance of getting marketing right. But, you got some Pepe to buy, next month. So as you go along, people get distracted. We heard some amazing stories from Trent there about the way that community can support the development of real utility. But on the financial side, in the markets, please don't be romantic about this. The people you will attract are incredibly speculation-driven and short-termist. If you're you won't escape this. It's a honeypot thing. The better your project is, the more speculators you're going to attract because you're in open markets. There are no controls. This is what permissionlessness means. It means you get human nature showing up at the door. Okay. And another thing that you see happen is that if you've been experiencing market shocks that rock entire markets, you'll find that your liquidity does not bounce back as quickly. If ETH and BTC recover, you somehow have this lame sort of, okay, a little bit more, but not where we were. It's like they leave the party and they're like, oh, we can go back in? Oh, let's try the next bar down the road. Again, it's just being realistic about the nature of these markets and who's in them. And then, to compound everything, you've got your investors who are liquidating their tokens because this is the entire point, okay? Why you have investors they can invest in equity, they can invest in tokens. Why are they investing in tokens? Yes, it gives them access to this sector, but from a financial perspective, the key advantage is that they are able to exit early. They are able to, they have access to public markets that allow them to liquidate early. And what we're seeing now, since markets have cooled, is that if you're having a conversation that's going well, they'll be asking you for equity now, much more than they did before, because that sort of like upside differential has come down quite a bit. And okay, what about the vesting? Isn't that supposed to keep us safe? Well, under the current arrangements, once tokens are unlocked, they're unlocked. This is the current standard. I think it would be interesting to explore maybe with account abstraction, creating higher level rules that limit when people can sell, but then we would need the investors to come in and say that's a good thing. But if they haven't been selling tokens for 6 months, they can do whatever they want with those 6 months worth of tokens, okay? Oh, and maybe you think you're gonna get some cover if you're an amazing project and that, okay, they're gonna hodl, they're gonna keep hold of the tokens. No. They've got an entire portfolio that they need to make work. If you are doing really well, you might be the one project that makes their portfolio perform and compensates for everything else that didn't. Okay, look at how many investments VCs are making. That might give you an idea of that kind of sort of exposure and behavior. Now, all of this is a little ironic, really. When I first came to this, some of the stories I was hearing was like, look, this is an answer to shareholder capitalism, which is always biased in favor of investors. You now have a common token, common financial asset around which all the stakeholders can coordinate. But if your stakeholders get value from your token in different ways, having a common instrument may actually create conflict. And in some ways, like, the incentives between founders and investors are much better aligned in the traditional scenario because they're joined at the hip for 5 to 8 years until they get to exit. So, the case that I've been making here is that tapping the financial value of your tokens through public markets is really risky and really shouldn't be taken lightly. And if any of you see the sort of fights that I get into on LinkedIn or whatever, I'm usually, whenever I hear people saying we're doing price modeling, I say, well, what are you doing? Well, hopefully this provides some context around why I'm so skeptical about or cautious about price modeling is because if people misunderstand what that represents or the certainty around that metric, they can stumble into some difficult financial decisions. So this leaves us in a really interesting situation where the private sale offers us the most control and certainty over what our tokens are worth. And it won't feel like that when you are knocking on people's doors and they're sort of like telling you what yes, no, yes, no. But really, you're at the mercurial whim of the markets later on, and this is when you can negotiate, when you can really take hold of what's going on. So, what is your token worth? Well, it's commonly said that things are worth what people will pay for them. Okay, this captures the spirit of market value. Okay, and that contrasts with another notion of value called fundamental value, where you use theory to define a measure or relationship between observable attributes of an asset or hypothetical attributes of an asset and what it's worth. Now, again, this is a point of difference between me and other very smart experts, but there is no consensus on a fundamental approach to the value of tokens at this stage, at this stage in a project's development. In a sense, it wouldn't need to be right or wrong. If everybody else was doing it, that would still be a valid point of coordination, but we don't even have that consensus. And as it stands, these methods are just so highly uncertain that I think it's all noise and not signal. I really don't think this is the right way to go, and I say we need to guide ourselves with a market value approach. And this is what your investors are going to be doing, because what are they in this game for? They want to generate a financial return, and they're going to do that by selling tokens in financial markets. So one of the key things they're going to look at when you present them with an offer is, am I buying this at a value where if I then bring it to market, it's likely to get an uplift? Is it going to be valued higher in the market? All this is a classic strategy of buy low, sell high. Okay? So what are the metrics that they look at in order to get a grip on this? One's called the initial market cap. This is the initial circulating supply of tokens multiplied by the listing price. Then you have the fully diluted valuation, which is all the tokens you've pre-mined or created at Genesis multiplied by the round each investor has bought at. Let's look at the meaning of these two things. The initial market cap is a measure of an estimation of trying to figure out, is the market likely to accept this valuation? When we go to our listing, is this like way out of whack with other projects that are sort of like comparable in some way? And for the fully diluted valuation, it's kind of similar to like saying, once all these tokens are unlocked and circulating, what's that valuation going to look like? Is that something that the market's likely to bear? It's implicitly a measure of dilution risk or inflation risk as well. And you need to read that out fully. You need to know, you need to look at your vesting schedules as well. Now, the trouble is that you need to make these comparisons not just with regard to public data, with regard to private data as well, because you are not going to be the only people pitching to these investors. There are entire groups of projects and investors all talking to each other, and they together create a private market that is subject to its own dynamics, right? And if bargaining power's in the hands of investors, they're going to negotiate sort of valuations that leave them with more chance of capturing upside. And if bargaining power is on the other side, that allows them to press for deals that keep more value for them and for their community. But we have a problem here. These markets are highly opaque. The only side that is constantly getting offers crossing their desks are the investors. The builders, the developers have plenty on their plate. So what can we do here? What do I think is the right approach? It's that you do some market research, and you do as much market research on the deals that have recently closed and those that are still open in the market that you think are similar to yours. And then you can create a chart a little bit like this, where you take metrics that define and summarize your offer, and then see, okay, how does this place relative to the maximum and minimum and the average in the market? Now, the goal here isn't always to hit, so here the blue triangles are the average values, the red diamonds are the live values running through the model. The goal isn't always to hit the average, right? If it's not at the average, it's to be able to say, okay, this is why we're not here, and prepare those arguments in advance in case they are brought up by your investors. And notice that at this point, This table includes many more metrics than just the valuation metrics that I mentioned, and that's because all these things are subject to, even your vesting terms are subject to these market dynamics. You know, I remember when there was a change in market regime, at some point suddenly vesting schedules lengthened by two years. That was the change we needed to make to get investors to accept that. Why? Because they had the bargaining power. So, you know, yeah, there was an economic argument, but that economic argument stemmed from the nature of the market and their beliefs about how the situation had changed. This is really hard to get hold of. It's opaque. We're collaborating on building a database that is queryable. That's me with a Token Engineering Academy, so hopefully we'll make progress with that. But if you're doing this for yourself, like any small amount of progress that you can make is better than going in blind, I promise. And something else this points to is that this is not going to be a one-shot exercise. You're not going to make your tokenomics, bring it to the investors, and then shop around, and then you'll get... No, because this is an open negotiation. This represents what's known in traditional finance as comparables transaction analysis. It's a completely normal approach, and it's used as a valuation lens when the value of of the asset in question is uncertain. And it says, okay, what's the kind of field that we need to get to a deal that is likely to be accepted? And yeah, the learning from that is that this is all in negotiation, and while you are still fundraising, you will have to change your offer several times and understand why. So that's why I recommend that you get hold of an amazing tool like the one I've built there. But you do have lots of other tools that are out there. I've seen a couple of people market theirs. But you know, so you might still get value out of the teaching course where I explain all these dynamics. And indeed, please do come on Saturday where we'll be working through how to build an offer from scratch, from the ground up, in a way that identifies and saves your interests and gives you the maximum chances of success. So thank you very much. I didn't time that. Do we have time for questions?
Brilliant. Unfortunately, we don't have time for questions, but I'm sure people will find you throughout the day. Roderick will be here and available for questions. And yeah, again, come to the bar camp on July 22nd and have the chance to work on a token offer live. Thank you so much, Roderick.
Thank you so much, everyone. Thank you.